Welcome to Delphos Insights. This is episode 23, where we examine corporate setup strategy in 2026. Expanding into emerging markets is no longer about access, it is about execution.
That is, I think, the pivotal distinction we need to make right at the start. For the institutional investors, CFOs, and, the development finance stakeholders listening, this isn't a conversation about filing paperwork.
Not at all. It's not about ticking boxes.
Exactly. This is a conversation about capital allocation and fundamentally about risk discipline.
It feels like a real reframing of how we view market entry. For years, the narrative was driven by this growth at all costs idea, right? It was about planting flags and capturing territory.
It was, but the research we've looked at for this deep dive shows the ground has clearly shifted.
We're moving towards a model that prioritizes margin protection, durability over just speed.
Durability is exactly the right word. The core argument here is that execution risk now far outweighs market access. In previous cycles, the main challenge was just getting into a market.
Finding the deal, securing the license.
Right. Shaking the right hands. That was the barrier to entry. But today the barrier is operational. The challenge is building the infrastructure that actually protects your capital once it's deployed.
So it's about the plumbing. If the corporate plumbing isn't engineered correctly from day one, you're setting yourself up for failure.
That's the perfect analogy. This isn't about administrative friction, it's about genuine asset protection.
And this shift isn't happening in a vacuum, is it?
Yeah.
It's being driven by a much tighter macro environment. The era of cheap money is, well, it's behind us.
And the data points really reflect that reality. They're quite stark. We're in an environment of capital scarcity. In 2024, global foreign direct investment, FDI, totaled $1.5 trillion US dollars.
And that's an 11% decline.
An 11% decline. But for our audience, maybe even more telling is that international project finance fell by 26%.
Let's pause on that. 26%. That is a massive contraction. It implies a significant pullback in appetite for development projects in key emerging markets.
It does. It means capital is scarcer, so the competition for entry is just tighter. Investors are, they're reshaping their behavior. They are looking for that durability we talked about, not just opportunity.
When capital is scarce, that good enough compliance framework suddenly becomes an unacceptable risk.
It's an immediate red flag.
So let's unpack what this means for the actual setup. The sources describe corporate services as the foundational requirement for disciplined business. That's a term that often gets pushed to the back office.
It does, but it's absolutely strategic. In rapidly developing economies, the quality of your market entry infrastructure determines if your early momentum even survives. If you see setup as just administrative, you're building on sand.
The phrase used in the analysis is structural enabler.
And that's what it is.
Yeah.
A corporate services framework has to support transparency and resilience. It's the enabler that lets a company scale without compounding regulatory risk. A flawed setup just magnifies every other problem.
So the mission here, the collective Delphos view, is about moving from short-term expansion to something truly sustainable.
It all comes down to execution discipline. A proper setup creates the compliant path you need to navigate the scrutiny that's coming. That's the why. Now we should probably get into the how.
Right. The sources outline a 2026 playbook. It seems to center on 3 pillars: front-loaded diligence, precision legal structuring, and high-certainty licensing.
And we have to distinguish this from, say, a developed market expansion. If you're expanding into Germany, the regulatory environment is relatively symmetric. You know how a contract is enforced?
That's predictable.
Precisely. In emerging markets, you don't have that symmetry. You need what we call sequencing discipline. You simply cannot deploy capital until you have regulatory realism.
You have to know the rules of the game before you start playing.
Too many investors do it backwards. They deploy capital and then try to figure out the rules. That's how you get stranded assets.
The sources mention specific tools for this. One that stands out is the World Bank Group's Be Ready platform. This seems to be the evolution of the old doing business rankings.
It is, and it's a critical tool for this front-loaded diligence. It evaluates about 1,200 indicators across the company lifecycle.
1,200 indicators. That's a huge jump in the amount of data compared to older metrics.
It gives you the granularity you need. It quantifies entry friction, administrative burden, dispute frameworks. It moves you away from anecdotal evidence. I heard this market is difficult to empirical data.
So a CFO can actually quantify the cost of doing business before incorporating.
Exactly. No more guessing.
And this diligence isn't just financial anymore, is it? The sources really highlight integrating ESG and workforce factors right at the start.
This is where we look at something like the Women, Business, and the Law report, which covers 190 economies.
Now, some listeners might hear that and think it's purely a social metric. How does that connect to a hard-nosed capital allocation strategy?
Well, it's critical for talent acquisition and for complying with global investor mandates. For example, are there legal restrictions on women working night shifts? If you're building a 24-hour manufacturing operation, that's not a social issue. That is a core operational bottleneck.
So you're aligning the local reality with the global mandate.
You have to. You need to verify that the legal structure of the market you're entering actually supports your goals.
Let's move to Pillar 2 of this playbook then. Legal structuring, GovTech, and transparency. The expert view here is a strong warning against copy-pasting structures.
It's a very common trap. You have a structure that worked in one jurisdiction, so you just replicate it for another to save time. In 2026, that's a recipe for disaster. Legal design can't be formulaic.
And the specific risk there is what the sources call compliance exposure.
Yes. If you ignore local laws at incorporation, you create defects in your structure. Remedying those defects later, once capital is flowing, is incredibly costly and creates delays that can stall a whole project.
And the government side of this is changing too. We're seeing this massive shift towards GovTech, the digitization of government interfaces.
It's a positive trend, but it demands adaptation. The World Bank's GovTech Maturity Index, built on 48 technical indicators, shows that between 25 and 26% of countries have improved their digital infrastructure since 2022.
A quarter of the world's governments upgrading their digital systems in just a few years.
Correct. It reduces friction, which is good. But it also means your corporate operating model must integrate with that public digital infrastructure for e-filing and licensing. You can't be on paper when the regulator is digital.
Speaking of regulators, there's this increased scrutiny on who actually owns these companies. Beneficial ownership.
It's a major focus. The Financial Action Task Force, FATF, updated their guidance on this on March 11, 2024. And this isn't just about compliance.
The sources suggest there's a real commercial necessity here.
It is absolutely a commercial necessity. World Bank enterprise surveys, which cover over 225,000 firms, validate that transparency reduces uncertainty. It strengthens community engagement and reduces social friction.
And if a bank can't easily verify ownership, they might just cut off liquidity?
They'll de-risk the client. Opacity is expensive.
That leads us to Pillar 3, operating resilience and cybersecurity. The emphasis is on tax, reporting, and cyber controls from day one.
Day one is the operative phrase. You cannot bolt these things on later. Cybersecurity in particular is no longer optional. It is a core control and a capital preservation issue.
The sources reference the NIST Cybersecurity Framework 2.0.
Yes, and it's worth listing the 6 core functions: govern, identify, protect, detect, respond, and recover.
With govern being the key addition that really places this in the boardroom.
It absolutely does. It elevates cyber risk to a governance issue, a leadership responsibility. And this is crucial because the risk isn't just inside your 4 walls. The sources note that 54% of large organizations cite supply chain dependence as their primary cyber risk.
Over half. So you're inheriting the risk of everyone you do business with.
Your control responsibilities must extend to third parties. If your payroll provider has a breach, you have a breach. You can outsource the task, but you can never outsource the risk.
And complicating all of this is data protection. It seems like every jurisdiction has its own rules now.
It's become a complete patchwork of regulation. Data protection requirements now apply in 144 countries, each with its own standards.
Which, for a multinational, requires harmonized policies, but country-by-country reporting.
The complexity is immense. This goes back to our first point. Execution risk now outweighs market access. Gaining access is the easy part. Managing data compliance across 144 jurisdictions is hard.
So we've covered the playbook. Let's look at where things go wrong. The sources identify 3 primary drivers of failure for 2026.
These are the common failure points we see again and again. Number 1 is licensing misalignment.
This is underestimating local content rules or just the administrative complexity?
Yes. You use benchmarks like be ready to calibrate, but if you underestimate the timeline, you just burn capital while standing still. 6 months of burn with 0 revenue because a license was delayed.
The second failure point is weak third-party controls.
This connects back to the supply chain risk. outsourcing know your customer or statutory filings without standardized oversight. It leads to audit deficiencies. The liability sits with the directors, not the vendor.
And the third.
Digital exposure, specifically lacking an incident response framework.
This goes back to the respond and recover functions of that NIST framework.
Exactly. You need a plan for when, not if, a digital incident occurs. If you're scrambling to figure out your response in the middle of a crisis, you have already lost.
The solution offered here is summed up as preemption.
The solution is discipline and execution, not just ambition and planning. That discipline provides a measurable competitive advantage. It protects capital, it protects reputation, and it transforms the setup phase from a hurdle into a real moat.
And this is where the firm's capabilities come in. Delphos works across capital raising, transaction advisory, corporate service setup, and cybersecurity to equip clients with this kind of governance.
It's about providing the infrastructure that lets the client focus on their core business, knowing that their foundation is secure. The goal is to remove execution risk so the investment thesis can actually play out.
We're coming to the end of our deep dive. We've covered the capital scarcity, the need for this structural setup, the new playbook with Be Ready and GovTech, and the critical importance of cyber resilience.
It creates a very clear picture of what's required. It's a more demanding environment, but for the disciplined investor, it's also a less crowded one.
Before we close, I want to turn it over to you for a final thought.
Yeah.
For the decision makers listening, the investors, the CFOs, what's the one thing they need to ask themselves right now?
As you look at your current emerging market portfolio, does your operating model rely on administrative hope? Or have you engineered the governance discipline required to protect capital against the inevitable regulatory and digital shifts of 2026?
This has been Delphos Insight. Learn more at delphos.co.